Hello, everyone. In times of market turbulence, calm matters more than speed. When prices swing and emotions rise, rational thinking becomes your greatest edge. This is a place to learn investing. Let's learn and grow together in the market. Investment disclaimer. By viewing this content, you agree to these terms. Predicting tomorrow's stock price with moving averages, building a simple forecast system. Hello everyone. In today's video, I'll show you a simple moving average system that predicts tomorrow's stock price. What is a moving average? A moving average is one of the most basic tools in technical analysis. It takes the recent prices, adds them together, and divides by the number of days. The result is a smoother line that helps us see the real trend, instead of daily noise. Short moving averages react faster. Longer moving averages move slower, but are more stable. Why moving averages matter for forecasting? Moving averages are not just lines on a chart. They tell us three important things. Direction. Is the market generally moving up or down? Speed. Is the trend accelerating or slowing? Pressure. Are buyers or sellers in control? When price stays above short-term and mid-term averages, it often means upward momentum is present. From MA to prediction logic. To use moving averages for forecasting, we don't guess a future price directly. Instead, we study recent price changes. First, measure how much price moves each day. Then, calculate the recent average of those changes. This tells us the current market momentum. If the recent average change is positive, we expect upward pressure tomorrow. If it's negative, we expect downward pressure. How MA supports this forecast? The moving averages help confirm whether this momentum is reasonable. If the short-term MA is above the longer-term MA, and both are rising, momentum-based predictions make more sense. If moving averages are flat or tangled, the market is usually ranging, then predictions become much less reliable. So MA is not only smoothing price, it filters when a forecast is worth considering. Simple formula idea. The basic forecasting idea is, tomorrow's estimated price equals today's closing price plus recent average daily change. Moving averages tell us whether that recent change is aligned with the broader trend. Important perspective. This approach will not predict the future perfectly, but it trains you to think correctly. Trends before guesses, data before feelings, logic before indicators. Moving averages become a foundation, not a decoration. Ending. If you want to learn how to use indicators, such as moving averages, to build real forecasting logic, feel free to visit our website. The link is in the info section. Also, don't forget to subscribe to our channel. In future videos, we will expand further, introducing more powerful prediction models and real trading experiments. Bye-bye.